as people, we got to pay attention to those rates.
Yeah.
No, I know you have one more question. I just want to jump in here for a second because, Jim, you made a comment earlier and it just kind of passed by. You said the new Great Depression. Are we in a new Great Depression?
We are. And by the way, thank you for mentioning my last book, Aftermath. If you have a copy of Aftermath handy, go to pages 288 to 291. Now, this book came out in July 2019. In those pages, I say there'll be a pandemic in the next 3 years, and there'll be social disorder and riots in the streets.
Well, it's your fault. It's your fault. We knew it was.
Well, anyone who read that book can't say they weren't warned. So again, read the whole book by all means. But
look, Jim, can I say one more thing? In the book, The Road to Ruin, you warned also that there were military vehicles stationed all around America getting ready for the riots.
Sure, and we were even closer with the book Aftermath. So everything we're seeing now was in that book. We have a new book coming out January 12th. It's publication day. It's available for pre-sale on Amazon. But Kim, to your point, the title of the book is The New Great Depression: Winners and Losers in a Post-Pandemic World. So if Aftermath a year ago told you where we are today, this book will tell you where we're going to be a year from now or even further ahead.
Can you give us a hint?
Well, we are in a depression. A lot of people don't know what a depression is because they, first of all, no one's ever lived through it. If you have a living memory of a U.S. depression, you are 90 years old. And my mother's 90, so she remembers it. We still talk about it. But you're 90 or older if you remember the depression. So very, very few people in that category. Most people have never lived through a depression. They don't know what it is. They assume must be a continuous declining GDP. It's not. Two quarters of GDP, of declining GDP, is the technical definition of a recession. But a depression means depressed growth. You can have growth in a depression. It's just the growth is below potential. So if your potential is 3.5%, and your actual growth is 1.75%, that gap between, say, 3.5 and 1.75, that gap is depressed growth. Now, if your debt is going up 5, 6, 7, 8% a year, which it is, and if your growth is 1.5, 2% a year, which it is, which it will be in my forecast, then your debt to GDP ratio, when your debt's going up faster than your income, you're going broke. It's as simple as that. So, but people aren't. We're looking at intergenerational changes, and again, it all comes out of the COVID pandemic. But the pandemic, the social unrest, and the depression, it all converged in 2020. We're not going to be out of this in 30 weeks or 30 months. It's going to take 30 years to get out of it. A lot of people don't know. The stock market reached a certain level in 1929. Do you know when then it crashed 90%? Do you know when it regained the 1929 level, when it got back to the 1929 level? 1954. It took 25 years to get back to where it was in 1929.
The Dow hit 381 and it took till 1954 to hit 381 again.
Correct.
Yeah.
But so it went down to about 30.
So what's the name of your book coming out, Jim? I'm going to get it.
The New Great Depression.
Great, thank you.
All right. That's such an exciting book. I can't wait to get it.
Well, better to see it coming than to get run over by it.
Yes, no kidding.
Such great news we got for everybody today. But anyway, the good news and bad news about the depression. But anyway, the last thing is...
Chapter 6 tells you how to make money. I remind people that Joseph P. Kennedy became one of the richest men in America by shorting stocks ahead of the Great Depression. So you can make money in depression, you just have to see it coming.
Yeah. Anyway, the last question is the debate between inflation and deflation. And I don't know if you pay attention to Peter Schiff, but his definition of inflation and deflation are different than your definition of inflation and deflation. And so the question is, are we heading for wheelbarrow money, where it takes a wheelbarrow of money to buy a loaf of bread? Or are we, what else are we going into? So
we're probably, I had a debate with Peter on this recently. It kind of reminded me of I forget the character, the Mad Hatter, maybe from Alice in Wonderland. He said, words mean exactly what I say, no more, no less. Peter has a definition of inflation that may work for him, but it doesn't work for the Federal Reserve, the European Central Bank, the United States Treasury, or anybody who's trying to figure things out. So I use consumer price inflation. I mean, just to be a little technical, the Fed uses something called personal consumption expenditure deflator year over year. That's a technical name, but it's basically just their personal core, by the way, core PC deflator year. It's just their personal definition of inflation. That's the one I use. It doesn't matter if I agree with it or not. If I'm trying to figure out the Fed and the markets, I better use the same tools the Fed is using, or else I'm going to miss it. So anyway, we're in for deflation, not inflation. We may get to inflation. We'll probably end up there. I agree it'll end up there. But we're actually living through a deflationary episode right now. And everyone's like, oh, look at all the Fed money printing. They printed $3 trillion in the last 6 months, which they did. They did print $3 trillion in the last 6 months. So that's going to cause inflation. No, that's what Milton Friedman said. Milton Friedman was wrong. The Austrian economists are wrong. Peter Schiff is wrong. Everybody, no, I'll tell you why. I'm not just going to throw stuff out there and not explain it. Money supply has nothing to do with inflation. Inflation is caused by velocity, which is the turnover of money. So let's just say you took the money supply from $4 trillion to $7 trillion, which is what the Fed did. Nominal GDP is money supply times velocity. This is just the quantity theory of money. This is Milton Friedman's famous equation, which actually goes back to Irving Fisher in the 1920s. Well, they took the money supply to 7 trillion. Okay, what's 7 trillion times zero? It's zero. In other words, if you don't have velocity, you don't have an economy. The thing that drives inflation is not the money supply, it's the turnover of money. That's the velocity. That's the zero in my case. Velocity has been dropping since 1998. It didn't start in 2008. It didn't start in 2020. It's been dropping like a stone since 1998. And it's getting closer to zero. So
wait, Jim, what does velocity mean?
Velocity is the turnover of money. So let me give you a very simple example. So let's say I go out for dinner and I tip the waiter. And the waiter takes my tip and she takes the taxi cab home and tips the taxi driver. And the taxi driver takes the tip and fills up his car with gasoline, okay? In that example, my dollar had velocity of 3. There was the waiter tip, the taxi driver tip, and the gasoline. So my dollar supported $3 of goods and services. So that's velocity of 3. What if I stay home and watch TV and don't spend any money? The velocity is 0. That's the point. It's not how much money you print. It's whether people are lending and spending, and they're not. And it's psychological, and the Fed cannot control the psychology. And you've got to change the psychology, get out of that deflationary problem, which, by the way, the only guy who did it successfully was Franklin Delano Roosevelt in 1933. And how did he do it? He raised the price of gold.
So anyway, this we could go on and on for all this. So when the Fed is printing money, PPP and CARES Act and all this stuff, which is helicopter money for everybody, it doesn't cause inflation because people aren't spending.
Correct. That's exactly right. And so the decision to spend or not is psychological. How do you feel? You feel prosperous? You feel like it's all good? Life's going to get better? I'll go out and drinks on me? Or you stay home and watch TV? That's a binary psychological choice.
And I heard that's happened a lot with companies and all that got the PPP money. They were nervous about what was going to happen, so they're sitting on it.